This is a busy week for earnings, and there are 5 very important stocks you should be watching, and they're not what you think. They're not Tesla or Alphabet. Both of them are also reporting this week, and we all will be watching those. But these are a few hidden gems, one gold miner, and a couple of other stocks that might tell us what is happening with the tariffs. So these are all ones you might want to tune in even for the conference calls on these. It's not going to matter so much on the miss or the beat, but we're going to take a look at that. But what's really going to matter is guidance and what they're seeing out there that's happening with both the consumer, the tariffs, and the economy, really, the global and the U.S. economy. So let's dive right in. Okay, we're going to start off with some good news. Yes, there is some good news out there. There are some stocks that are still busting out. They're rare, but I found one, and it's CME Group, ticker CME. And as you can see on the chart, they are an earnings all-star. Just this one miss back here in 2020 during the pandemic, and it was small, just 2.1%. Otherwise, it's got a great earnings surprise track record. Look at all these little green arrows mixed in here. It doesn't have to be big beats to still be a beat. This is just 3.2%. And CME Group is always kind of very consistent in what they do with earnings. And they're good at telegraphing what they're looking for the analysts to make their earnings estimates and for this chart to happen. So I'm loving that. And then look at the earnings. We are not seeing declines here. We are seeing actual increases in both 2025 and 2026. And why would that be? CME Group dealing with a lot of the trading, and we are seeing a spike in the VIX. And that means there's a lot of trading going on in various things, including commodities, stocks, bonds, at just basically everything right now is in flux. And that is good for a company like the CME Group. And so that's why we see it rising. CME Group is actually up almost 13% year to date. It's at this new high, and it's not super expensive on a PE basis, trading around 24 times. So it's getting a little stretched there, but people looking for a place to hide out, and that still has the rising earnings estimates. This is one to be in. So that's CME. We're all going to be watching it. Very important chart this week. Okay, but let's switch to the other side. This is an AI revolution stock. I own it in my own personal portfolio and in Zach's. Value investors, several other editors also own it in their newsletters here at Zach's as well. And it's Vertiv, ticker VRT. This one up in the air, but it's the first of the AI revolution stocks we're getting this earnings season. They are in partnership with NVIDIA, so they're kind of a bellwether for what NVIDIA may report a couple of weeks from now because they go so much later in the earnings cycle. But take a look at this chart. Year to date, now down 38%. It has bounced off of those lows, but can it even hold it here? And now we're starting to see some cuts to the earnings estimates. You can see a little decline right there in 2025, little bit in 2026. Analysts unclear and starting to falter a bit as we're getting word that maybe some data centers might not get built or there's delays on the data centers. Remember, Vertiv makes the stuff that goes inside the data centers. They're making the racks that hold the chips that go inside the data centers. So all of these data center plays were AI revolution plays. But this is the street really rejecting the AI revolution story here. That's what we got, the 38% sell-off. It's trading at 21 times as those earnings come down a little bit. That's a lot cheaper than way back here in 2024 when it was at 40 times earnings. So we're seeing a bit of re-rating on these AI stocks. This is the first one to report. It's going to set the tone. So I'm going to be tuning in, and you should be too. That's Vertiv, VRT. Now let's go back to some good news. If you managed to be in the gold trade, you probably bought some gold miners. And this is another one that is up on the year to date. Newmont Mining, the largest of the gold miners and US based, ticker NEM. And you can see it's been a wild ride on these shares. Look at back here in 2022 with gold way lower. You can see it hit that high. And then it was just terrible through 2024, got another rally. This is what many of us here in late 2024 got stopped out a lot of our shares. I did not own Newmont, but I owned Barrick in the value investor, and we got stopped out here and had to get out of this trade. But we're back into some other gold miners, not Newmont, but the trade is back on. We've got gold at $3,400 an ounce, new all-time highs, and even inflation-adjusted all-time highs compared to the highs in 1980. So this goes right to the bottom line with the gold miners, as long as they can get it out of the ground. Execution has been a problem with a lot of the gold miners. There's a lot to take into account. They don't have gold mines just in the US. They are global, and it depends on what's going on globally. There's a lot of geopolitical issues. There's labor issues. There's a lot that goes into the costs. Mining is very expensive. You have to build the mine. You've got to get it out of the ground, just like with oil. So that is all big costs. But these miners mostly have costs in the range of $1,400 to $1,600 an ounce. So they're getting more than double their costs now. That's going to go right to the bottom line. They're going to pay down some debt, but they're also going to give it back to the shareholders. So with these gold miners, look for a base dividend, but then variable dividends plus some share buybacks as the cash flow just rolls in. Last quarter, these gold miners averaged about $2,500 to $2,600 an ounce. But that was Q4. Q1, it may be a little bit higher, but we really didn't see over 3,000 until now, Q2. But the market is pricing in even better, free cash flows going forward. This is similar to the oil trade we saw when the Ukraine war started. They are going to really rake it in. So if you're looking for companies with good free cash flow, these are the ones. And then look at what's happening with earnings. They were down. We're down considerably here. The analysts were getting a little bearish here, but now they can't not with gold at these prices, because anyone, even with the worst execution, as long as you're bringing out one bar of the gold, you're going to be okay, but you got to bring it out of the ground. So earnings estimates on the rise here. They did have a big beat last quarter. Finally, starting to see that these analysts maybe can't keep up. Wow, 47% earnings beat. You got that long green arrow there. So we're not really super concerned with the beat here. We are a little bit with, what price are they getting it out of the ground? How much are they getting it out of the ground? Are we going to see any increase in production? The bad news would be a decrease in production, but the price of gold is surging at such a rate that price can make up even for a production decline, which some of these do have. So Newmont, I'm going to be watching the first of the big gold miners. We're going to get a couple others this week. But this is the first one, PE of just 14, because those earnings estimates are now on the rise. So I like the gold trade. I'm in it. I'm not in Newmont, but I'm loving what's happening here. And look at these shares. They're not even back to 2024 highs yet. So maybe this is a value here, but something good is brewing in the gold miners. So that's Newmont, NEM. Now let's look at some consumer-based companies, because we are getting a lot of them this week. One of the ones I've been watching for years is Corp. We were watching it for years because look at over here during the pandemic. Everyone was staycationing. They were putting in pools during the pandemic. So earnings soared to all-time highs here in 2020, 2021. Remember, it is a global company. They have pools in Australia and the US, maybe a few other places, but those are the warm locations. So they are building pools, and they sell all the equipment, outdoor goods as well. But Pool Corp, the price to put one in has risen, and also the price of money in the US has gotten more expensive. If you're taking out a loan to put in that pool, you're going to pay for it now. And so a lot of people have put it on hold. but they are doing repairs to their older pools to keep those as long as possible. So the repair side of the business is still doing fairly well, but the pool, the new pool business, not quite so much. And you can see that in the estimates, they already started dropping last year. The rates were raised, here in 2022. That's why we've got all these declines. But analysts still bearish here. You can see the decline still happening for 2025. 2026, this is also giving it a little bit higher PE at 27 times. It's not dirt cheap. And also the stock really hasn't broken down. I've talked about this. Year to date, it is down, but just 8% on something that is this tied to the consumer, feeling good. I do expect further breakdown, and then I might be interested. But we're looking back here at the 2022 lows as the next area of resistance, and then we would have to go all the way back here to basically pre-pandemic probably levels on pool. So we'll see what they are saying and what they're seeing. It already has been bearish, but is it going to get more so? And what kind of impact is the tariffs going to have on their business? Because they're not manufacturing all the pool supplies, the outdoor furniture, and the little puffy swan that you blow up and put in the pool. That's all being made somewhere else that is likely being impacted by the tariffs. So this is what we're waiting for, and I'm going to be watching. That's pool, Pool. And then we're going to wrap it up with one that got impacted by the tariffs in 2018, 2019, Whirlpool, WHR. So it is already known the tariff situation. It is already known the slowdown in housing, which has impacted new housing. So as those sales decline 30 to 40%, well, what's not going in to the new house? Appliances. The appliance sales are way down. You can see it in all the earnings cuts here. Down, down, down. We're kind of flatlining here, but a little bit of a decline even here for 2025, 2026. It's just a bad scene until you have housing turnaround. And now if we have a recession, that's also a bad scene for appliances. It's below the pre-pandemic lows or pandemic lows back here. We're now at 5-year lows. So year to date, shares are down another 31% and PE of just 8.5. So it is cheap. But if these estimates are cut further here, it's going to get to be more of a value trap. Yes, I'm saying that at 5-year lows, but it does have this dividend yielding almost 9%. And that gets into a little bit of the danger territory with some of these stocks when you get the dividend that high. I did take a look a little bit ago to just see are they going to be keeping that dividend? They can afford the dividend. Let's look at the detailed estimates real quick on this one just to look. Okay, so we're now looking for 927 for this year. That's down from 1129 just 90 days ago. So that's a pretty strong cut in these in the consensus there for the earnings for this year. And then over here on the quote page, we're paying $7 for the dividend. They have been very strong shareholder friendly company. And I don't see any indication that they're intending to cut this anytime soon. But you have to know when you start to see the dividend yields on a non-REIT going to this level, or an MLP like a pipeline that normally does not pay 9% dividend, that something else is going on that's not good for the company to get into this situation. So be warned there. But I'm a big believer in this company has survived the pandemic and other recessions and things. So we're always going to need appliances, and it will turn around on the housing side. We will get past any possible recession. Even this trade war will end eventually. So I'm keeping this one on my watch list, but I am tuning in this week. Whirlpool are not looking good here, but I will be checking in on this conference call for sure. So these are 5 of the most important stocks to watch this week, in addition to the tech names in my other video. Make sure you're watching both of them, but these going to give us some real insight into what is going on out there and what will happen with the earnings. Can they even give us guidance? Someone like a CME group probably can, but many of these others, not so much. Although I do expect maybe the gold miners to also give us at least something. They usually give it in chunks, like if gold goes to this level, but 3,400 in gold is even beyond what they were estimating when they gave like end of the year updates just a couple months ago. So lot going on. Make sure you're watching all these videos. I'm going to be tweeting out all of these earnings charts and more all week long. Over 100 companies in the S&P 500 reporting this week. So be sure to tune in to my social media accounts on Twitter. I'm on Blue Sky. I'll be on StockTwits as well all week long. And I'll be back next week with some more earnings charts.